What's going on, everybody? 2024 Ignite Financial. Matthew Myers here with your daily update and dose of financial information. So today we are going to talk about different mutual funds and ETFs. Quite a few questions about this. Hey, is one better than the other? There's been a big probably outflow of mutual funds over the last decade. A lot more inflows into ETFs. Is it good, bad? Give me the skinny on it, Matt. So that's what I'm here to do. Educate you, make sure you can make better decisions going forward. And of course, I am always here to address any questions that you might have and assist you in your financial journey. So let's talk about mutual funds first. So mutual funds have been around for a very long time. Much longer than ETFs have been around. And so the way the structure of mutual funds is that they are typically going to be actively managed. Now, when ETFs first came out, they were almost exclusively passively managed. So what do I mean by that? So when I'm talking about active management is that a mutual fund and an ETF are both going to be composed of some sort of investment. So that investment could be stocks, it could be bonds, it could be commodities, it could be a mixture of stocks and bonds, or even throw in some commodities in there as well. So there's going to be something that's inside the fund itself. And then the fund is going to have an objective. So if you remember in the good old days before we got all the prospectus information delivered to us electronically, you buy a mutual fund, in a couple days later, you get this really thick, booklet that typically had the information for that mutual fund and others within that fund family. And you could read through it. I'll tell you, if you want to fall asleep, just read a prospectus, right? You get finance people and then you get lawyers writing, information together. It's not exactly, compelling information that's going to make you want to stay awake and be on the edge of your seat, waiting to turn the next page and see what happens next, right? But in it is great information because it's going to have the expenses associated with that fund. It's going to have the objective of that fund. So if the fund its objective is is growth oriented, it's going to be what does it define as growth? What is a growth stock? Maybe it's a large cap growth fund. What's large cap? So it's going to define all those parameters in there. So you're going to have a money manager or money managers, as is often the case, especially with bigger funds. You have a team of individuals who might be managing it, or just one person who kind of oversees it with a lot of individuals helping out with the research. And so it will be defined what's in there. So the person just can't go rogue. They just can't decide that they want to invest in whatever they want to invest in, and they go completely away from the objectives. So there are some constraints on funds and what they can do with it. There's going to be diversified funds versus non-diversified mutual funds. The vast majority of mutual funds out there are going to be diversified. Simply means that you can't have more than 5% of the portfolio composed of one stock. When you get into non-diversified, you'll have over 5%, but generally there's still going to be constraints in there, right? You can't put 100% of your portfolio into one stock. It simply doesn't make sense. So they might say, okay, maybe you're non-diversified, but you still can't have more than 15 or 20% of the fund in one stock, which still, depending on the size of the fund, would be a massive amount of stock to hold in one fund. So vast majority are diversified. So they have an objective to them. They're actively managed. What active management means, I guess going back to the original question, right? Active management means that somebody's looking at that portfolio and they're making adjustments based on the information that they have. So based on the information they have, and let's say the portfolio is composed of 1,000 stocks, 100 of these stocks no longer meet their objective to stay within the portfolio, then they kick those 100 stocks out. At that point in time, they may keep it in cash or move to treasuries. Typically, Most funds will allow a certain percentage to be in cash or in interest yielding instruments like treasuries for at least a short period of time. They could reinvest it into something else. So really, it's based upon their objectives, what the information is telling them, and then they're going to act on it. So 1,000 stocks in the portfolio, maybe it's 900. They just see too much risk in the marketplace at this point in time. They decide to keep that cash in there for a little bit, wait for a market maybe to pull back, look at a buying opportunity, or wait for a signal from the feds, and then they go ahead and they make their next move, purchasing additional shares of stock that they already have in there, or purchasing new stock. So that's going to be active management. So somebody on a daily basis is looking at that portfolio and making adjustments based on the portfolio itself. ETFs typically were passively managed. So what passive management means is that they're put together, an index. So most ETFs initially were just index type funds like the S&P 500 and NASDAQ, the Russell 2000. They put together an index that's mirrors like the S&P 500, and they don't do anything with it until the S&P 500 changes their mix, which is typically could be once a year. Maybe they'll do it 2 or 3 times a year, depending on how volatile the year is, depending on how accelerated some stocks moved, either up or down. But they don't make a whole lot of changes. So it's passively managed. Well, with that passive management, it's going to be less cost. And so that was a big selling point of ETFs initially was, they're lower cost compared to mutual funds. And so is it good or bad? I mean, I certainly have my opinions on looking solely at cost. So sometimes you get what you pay for, right? You get a really good active manager who realizes that there's 500 companies in the S&P 500 and not all of them are growing and accelerating. You have companies that are moving down the list of the S&P 500 or moving out of the S&P 500. Why would you want to be investing in those companies? Russell 2000. I think last time I checked, 35% of those companies, they don't make a profit. So maybe based on how you want to invest, you don't want to invest in companies that are not currently making a profit. Doesn't mean they won't make a profit in the future. Honestly, there's a reason that people are investing in those companies. They see something in them. But if that's not something that you want to do, maybe you don't want to invest in the index that includes those companies. And so you're willing to pay a little bit more to not have those companies inside the index for you. And so there's certainly reasons why cost is something to be considered, but it's certainly not the biggest thing to look at. You definitely want to look at the overall performance of the portfolio. Does it align with your risk tolerance? S&P 500, it's going to move maybe more than a portfolio that's 300 stocks composed inside the S&P 500, but they're more stable, more financially sound. And so maybe there's not as much volatility and something that you're more in line with as well. So we got active management associated mainly with mutual funds. Historically, that's how it worked. And for the most part, mutual funds still are actively managed. ETFs, they were typically known as being just passively managed, but there's a lot of active management ETFs now. So, simply saying they're passively managed doesn't quite jive like it used to. How do they trade? So one feature that individuals didn't like about mutual funds is that if they wanted to get out of it, let's say the market was moving against them, they're really nervous. This news came out, it's really bad news, and they know that the market's just going to take a hit for a while, and they don't want to participate in that. So they call up their advisor, they place a trade, and they're like, hey, what would I get out at? And well, I don't know. Well, what do you mean I don't know? Well, mutual funds trade at what they call NAV, or net asset value. They basically take all the funds, all the stocks inside that mutual fund, they divide it by the number of shares outstanding, and that's going to be the net asset value. So you're paying exactly what the value is for all those investments inside that mutual fund. So you don't have to worry about whether or not you're paying too little or too much for it. Paying too little is not a bad thing, right? But if you're selling it, you don't want to get less than you would expect. So net asset value when it comes to mutual funds. ETFs, on the other hand, those trade throughout the day. And so they trade just like a stock would. So stock market opens up, ETFs are available to trade, and then those are going to trade at either a discount, at par value, or at a premium. Now, when we're dealing with an ETF that is actively traded, there's not going to be too much discrepancy from its par value. And what I talk about with par value is taking basically all the investments inside that ETF divided by the number of shares outstanding, and that's the par value. So the par value could be $20 per share, but it's trading at, say, $21. So you're paying a premium. You're paying more than the actual value of all those stocks inside that ETF if you're paying $21 for it. If you're selling it, that's great for you. If you're paying for it, maybe that's not something you want to participate in. And so mutual funds would be a better direction to go for that. Or you believe that sector is so poised for growth, you're willing to pay a premium price just to have a basket full of those stocks than paying the par value. Now, when we go back to those very, very actively traded ETFs, they rarely deviate very much from that par value. So it could be a few pennies, in premium or a few pennies in discount. So you're not going to look at a large deviation. When I've looked at ETFs in the past, there have been times where we've seen, premiums or discounts as high as 40 or 50%, but those are typically going to be with very thinly traded ETFs and not with the ones that you're going to see advertised or ones that are very, very liquid. In other words, when you're looking at the share volume for the day, how many shares are being traded? If you're seeing millions of shares being traded, good indication it's going to be trading pretty close to its par value. Or if you're seeing that there's 200 shares traded per day, there's a pretty good chance that there's either being traded at a discount or a premium, or there could be a big spread between the bid and ask, which the bid is what you're selling it for, the asking price is what you're paying for it. And so you want to take a look, is this an ETF that I want? Is there liquidity in this ETF? And then there's sources online that you can go and check out the current par value of that ETF. Typically, it's going to be based on the previous day's closing price, but you can still get a general idea whether or not there's much of a discount or a premium associated with that ETF. So given that, why would people trade ETFs instead of mutual funds? Well, part of it is going to be the cost associated with it, the liquidity of it. ETFs are going to be liquid. So if we go back to that example where the person's selling their mutual fund and it trades once per day, and that's at the end of the day where they buy and sell all the mutual funds at the same time based on that net asset value, maybe that's too late for this person. So they want to know that if they need to get out, they can get out right away, or they can get out at a price point that they want to, not waiting till the end of the day to place that trade. There also is going to be some tax efficiency when it comes to ETFs versus mutual funds. You're typically not going to see as many capital gains or capital gains at all associated with ETFs. And that's simply because of the way that it's created. So there's in-kind redemptions and creations. And basically they can exchange securities of an ETF in kind. So that means when a redemption occurs, the ETF can distribute securities instead of selling them, potentially avoiding capital gains taxes. So that's simply the buying and selling inside the fund itself. With mutual funds, if they buy and sell a stock inside the mutual fund, it's going to create either a gain or a loss on that stock, and that gets transferred to you at the end of the year through capital gains. And so you'll receive a 1099 showing the capital gain distributions on that fund. And so if they were holding a lot of highly appreciable assets and they had to get rid of those assets, it could produce a very large capital gain for you at the end. And you have to pay taxes on that if this is not held inside a qualified account, such as a 401k or an IRA, where you're kind of in that little tax bubble, right? You don't have to worry about that. So it's very important, especially when we're dealing with non-qualified assets. So when we're talking about assets that are not inside that retirement bubble, it produces what they call tax drag. And so tax drag can reduce the performance of your fund. So if we have two funds with identical performance, say that this mutual fund has an 8% performance, this ETF has an 8% performance, and the mutual fund does a bunch of distributions and capital gains and dividends at the end of the year, and the ETF does not have that because, again, they're exchanging baskets instead of buying and selling. The tax drag on the mutual fund could be 2%. The tax drag on the ETF is maybe 0.2%. Your 8% return is really like a 6% return when we consider the tax drag, because you're going to have to pay taxes on all those capital gains, dividends, interest on the mutual funds. The ETF, it may generate some dividends, may generate some interest income for you. Or if you sold it, you'll have gains or loss associated with the actual buying and selling the ETF. But because of how they exchange the securities inside of it, it's not creating that capital gains that we see within mutual funds. So that produces a situation where it's a lot more tax efficient for individuals with non-qualified accounts to invest in ETFs as opposed to mutual funds. So definitely something to think about. There's some other things that to consider. I mean, there's tax lot management, that they'll do as well inside ETFs, but they do some of that inside mutual funds as well to try to minimize the tax ramifications. But overall, mutual funds are going to be less efficient for you. Let's see here, man, all sorts of good notes here. Last part I'll just talk about is mutual funds tend to have some sort of minimum to get into the fund itself. So when we're talking about IRA accounts, lots of times it's just $500, maybe $1,000 to get in to the investment. Now, if you've been investing for a while, you're like, well, that's not a big deal. But if you're just starting off and you're just trying to get your foot in the door and you want something that's diversified, maybe you can't afford $1,000 right now. And it's going to take you 10 months because you're saving $100 a month for this investment. If you go into an ETF, the ETF is trading at $30 per share, then you could purchase the ETF shares without having to worry about that minimum. And you could, purchase 3 shares per month and just keep on accumulating the shares instead of just having your cash being idle during that time period, instead of potentially working for you in the stock market. So both mutual funds, ETFs, they're great. I mean, they're diversified. They're going to have stocks, bonds, commodities, other investments inside of them for you. Tax efficiency, ETFs definitely had the advantage. Expenses, historically, ETFs were less expensive, but the cost of mutual funds has come down dramatically. So it's more in alignment and closer than you probably realize if you haven't looked at it more recently. But really it comes down to, where are you investing the money? Is it in a qualified account or is it a non-qualified account? And how quick do you need liquidity to those funds? If you're not concerned about it, and this is an investment that's going to last for years and years and years, then liquidity probably isn't a big concern. If you want a little bit more control over it, and you want somebody who's looking at it, on a more frequent basis, mutual funds, have the advantage. There are actively managed ETFs, but mutual funds tend to have the advantage when it comes to active managed. So there's not a right or wrong. It's not one's good, one's bad. It's just that they're different. And understanding the difference is going to help you make a decision when it comes to your investing. I'm Matthew Myers, Ignite Financial. Have a great day. We'll catch you tomorrow.